Welcome to Pride Education. Today our lesson is Balance Sheet. Introduction. Welcome to Pride Education. In today's lesson, we will learn about the balance sheet, one of the most important financial statements in accounting. Every accounting student, business owner, investor, manager, and creditor should understand the balance sheet because it shows the financial position of a business at a specific date. The balance sheet provides information about what the business owns, assets, and what it owes, liabilities, as well as the owner's equity or capital. It helps users determine the financial strength and stability of a business. Unlike the income statement, which measures performance over a period of time, the balance sheet presents a snapshot of the business's financial position on a particular date. What is a balance sheet? A balance sheet is a financial statement that reports the assets, liabilities, and owner's equity of a business at a specific point in time. It shows the financial condition of the business by presenting everything the business owns and everything it owes. For example, if a business owns cash, inventory, furniture, machinery, and buildings worth Rs. 5 million and owes creditors and bank loans of Rs. 2 million, the remaining amount represents the owner's equity. Definition of balance sheet. A balance sheet may be defined as a financial statement that shows the assets, liabilities, and owner's equity of a business at a particular date. It is sometimes called the statement of financial position because it shows the financial status of the business. Purpose of the balance sheet. The balance sheet serves many important purposes. Shows the financial position of the business. Displays assets owned by the business. Shows liabilities payable by the business. Determines owner's equity. Helps investors evaluate financial strength. Helps banks assess loan applications. Assists management in decision-making. Supports financial analysis and planning. Importance of the balance sheet. The balance sheet is extremely important because it provides valuable information to different users. 1. Measures financial position. It shows the financial condition of the business at a specific date. 2. Helps investors. Investors analyze assets, liabilities, and owner's equity before investing. 3. Assists creditors. Banks and lenders use the balance sheet to judge repayment ability. 4. Helps management. Managers use balance sheet information for planning and controlling business operations. 5. Supports business expansion. A strong balance sheet helps businesses obtain financing for expansion. Main components of a balance sheet. The balance sheet has 3 major components: assets, liabilities, owner's equity. 1. Assets. Assets are resources owned or controlled by the business that are expected to provide future economic benefits. Examples include cash, bank balance, accounts receivable, inventory, furniture, machinery, building, land, vehicles. Assets are generally divided into current assets and non-current assets. Current assets. Current assets are expected to be converted into cash or used within 1 year. Examples: cash, bank balance, accounts receivable, inventory, short-term investments, prepaid expenses. Non-current assets. Non-current assets are held for long-term use. Examples: land, building, machinery, furniture, vehicles, equipment. These assets help generate income over several years. 2. Liabilities. Liabilities are obligations or debts that the business owes to outsiders. Examples: creditors, bank loans, accounts payable, outstanding expenses, notes payable. Liabilities represent claims against business assets. Current liabilities. Current liabilities are payable within 1 year. Examples: accounts payable, short-term loans, outstanding salaries, outstanding rent, taxes payable, non-current liabilities. Non-current liabilities are payable after 1 year. Examples: long-term bank loans, debentures, mortgage loans. 3. Owner's equity capital. Owner's equity represents the owner's investment in the business after deducting liabilities from assets. It includes capital introduced, additional investment, retained earnings, less drawings. Owner's equity represents the owner's claim on business assets. Accounting equation. The balance sheet is based on the fundamental accounting equation. This equation always remains balanced because every transaction affects at least 2 accounts. Why is it called a balance sheet? It is called a balance sheet because the total assets must always equal the total liabilities plus owner's equity. If both sides are not equal, it means accounting errors exist. Format of a balance sheet. A simple balance sheet consists of 2 sides. Left side, assets. Right side, liabilities. Owner's equity. Modern businesses often present assets first, followed by liabilities and owner's equity. Example of a balance sheet. Suppose a business has the following balances. Cash equals Rs. 100,000. Inventory equals Rs. 150,000. Furniture equals Rs. 200,000. Machinery equals Rs. 300,000. Total assets equals Rs. 750,000. Creditors equals Rs. 100,000. Bank loan equals Rs. 150,000. Total liabilities equals Rs. 250,000. Owner's equity equals Rs. 500,000. Since assets equals Rs. 750,000. Liabilities plus owner's equity equals Rs. 250,000 plus Rs. 500,000 equals Rs. 750,000. The balance sheet balances correctly. Classification of assets. Assets may also be classified into tangible assets. Assets having physical existence. Examples: building, machinery, furniture, vehicles. Intangible assets. Assets without physical existence, but having value. Examples: goodwill, copyright, patent, trademark. Classification of liabilities. Liabilities are generally divided into current liabilities, payable within 1 year. Examples: accounts payable, outstanding expenses, short-term loans, long-term liabilities, payable after 1 year. Examples: long-term loans, bonds payable, mortgage loans. Relationship between balance sheet and income statement. The balance sheet and income statement are closely related. The net profit earned during the accounting period increases owner's equity. Similarly, net losses decrease owner's equity. Therefore, the income statement directly affects the balance sheet. Relationship with the accounting cycle. The balance sheet is prepared near the end of the accounting cycle after recording journal entries, posting to ledger, preparing trial balance, making adjusting entries, preparing adjusted trial balance, preparing income statement, preparing statement of owner's equity. Finally, the balance sheet is prepared to show the financial position. Advantages of the balance sheet. Shows financial position clearly. Helps investors evaluate business strength. Helps creditors assess repayment ability. Assists management in decision-making. Supports financial planning. Helps calculate financial ratios. Useful for obtaining loans. Provides information about business resources. Limitations of the balance sheet. Shows position only on one date. Historical costs may differ from market values. Some intangible assets may not appear. Depends on accounting estimates. Does not directly measure profitability. Therefore, it should be analyzed together with the income statement and cash flow statement. Common financial ratios using the balance sheet. The balance sheet is used to calculate important financial ratios such as current ratio, quick ratio, debt ratio, debt to equity ratio, working capital, equity ratio. These ratios help evaluate liquidity and solvency. Users of the balance sheet. The balance sheet is useful for business owners, investors, shareholders, banks, creditors, government agencies, auditors, financial analysts, management. Each user analyzes the balance sheet for different purposes. Practical importance of the balance sheet. In real business life, the balance sheet helps answer important questions. Does the business have enough cash? Can it pay its debts? How much does the owner actually own? Is the business financially strong? Should investors invest in the business? Should banks approve loans? Thus, the balance sheet is a vital tool for financial decision-making. Conclusion. The balance sheet is one of the most important financial statements in accounting because it presents the financial position of a business at a specific date. It shows the relationship between assets, liabilities, and owner's equity, and is based on the fundamental accounting equation. A properly prepared balance sheet helps management, investors, creditors, and other users understand the financial strength and stability of a business. Together with the income statement and cash flow statement, it provides a complete picture of business performance and financial health. A strong understanding of the balance sheet is essential for every student and professional studying financial accounting because it forms the foundation of financial analysis, business evaluation, and sound financial decision-making.